Welcome to all of you who are joining us for our Safe Policy Lecture. This is a series of events which we now have been running for a long period of time. And we always try to contribute to the public debate and try to address issues with quite some significance and importance. And we are happy today, very much appreciate that we have two outstanding contributors to this debate. One of them for a very long time. I could somehow declare myself as a remote student of him. And the other one also an old hand, very experienced. So it's our great pleasure to welcome tonight Charles Goodhart and Manoj Pradhan. Charles Goodhart is known to all of us as a long-term central banker, somebody who's been elucidating monetary policy issues, always with an eye on practical perspectives. He has written outstanding books. Money, Information and Uncertainty is one of those books which most of us often use. And in addition to that, he's always been looking at how to support policymakers in practical issues. He's been defending, by the way, the idea that interest rates is the short-term monetary policy instrument long before it was accepted in the theoretical literature. So Charles is one of our heroes also because he has been very important in organizing financial research at the London School of Economics. Manoj Pradhan is currently the founder and head of Talking Heads Macro. Before that, he was head of global economics at Morgan Stanley. And actually, that's where the topic the two of them will discuss today started off. They wrote a very interesting piece in 2015 when they thought about what are the consequences of the shock to labor supply, which came with very benign effects for almost a generation, and which is about to turn. So that's the argument which they developed in 2015, and they've been working on it over the last couple of years and put it into a very, very useful and interesting a book at times gloomy, at times very sobering. So I hope this was not too negative a start for you, Charles, to begin. If it was, please be polite with me. Charles.
Thank you very much, Hans-Helmut. You've been a friend and a colleague for a long time. It's always been a great pleasure to be with you and to be associated with what you are doing. So it's a great pleasure for us to be here this evening. I'd actually like to start, if I may, with our PowerPoint slides. Thank you. What I'd like to just emphasize is how quite extraordinary the developments in nominal variables have been over my lifetime. And for about the last 70 years, from about 1950 onwards, you've had these two quite extraordinary trends, both upwards trends in long-term interest rates, and then an equivalent and even deeper downwards trend, which has driven interest rates, nominal rates, to a level that they've never been before. And this compares with what appears to be relative stability over the 2 or more centuries before then. And this kind of pattern is repeated in the US and in a number of other countries. And what it suggests is that nominal variables, such as inflation, expectations of inflation, nominal interest rates, were all remained relatively constant until about the 1950s, then shot up, and since then have shot down. Now, how has this occurred? Now, since these are nominal variables, everyone will say, well, this must be related to changes in monetary regimes. And to a degree, that undoubtedly is correct. With the abolition of the gold standard, the switch to the Bretton Woods system, and then after 1972, you had the floating rate system, if you call that a system. And undoubtedly, the decline in inflation that we've had since then, the decline in interest rates, has been due to much better monetary policy as such. But just as Milton Friedman said, inflation is always and everywhere a monetary phenomenon, which is in a sense true. We were talking with Roger Bootle, who reminded us of another phrase, which is that shooting is always a ballistic phenomenon. And the point of that comment is that, yes, monetary variables have to be consistent, but you need to know the context which led to the monetary developments that allowed this upsurge in inflation and expectations of inflation and then reversion to occur. And indeed, the upsurge from 1950 to the very early 1980s, the end of the 1970s, was due to a lot of factors, which were not only monetary. It was the switch to manage money, Keynesian policies, and in particular, the politicians of that era had lived through the Great Depression, and that had imposed a very strong impression on them that you should try to run the economy at as high a level of employment as you possibly could. And if that should lead to inflationary pressures, you should try and deal with it through direct wages and prices control. And it failed, as did wages and prices control, although in many ways it was a laudable enterprise. And similarly, the decline in inflation since the beginning of the 1980s owes a great deal to central bank inflation, central bank independence, inflation targeting, and the success of central bankers in achieving their inflation targets. But the point that I want to make here is that it was actually less difficult for central bankers to do it than one might have thought, in the sense that the achievement of the inflation targets was undertaken at a time when there was a steady downwards movement in interest rates, a downwards trend in nominal and to a large degree in real interest rates at the same time. Yes, there were cyclical, counter-cyclical cycles in interest rates and in policy, but in general, you could achieve, or the central banks were able to achieve their inflation target, while at the same time enjoying steady decline in interest rates. And moreover, after the great financial crisis in 2008, 2009, despite trying to maximize the expansionary effect of monetary policies, they weren't actually able to achieve their inflation target. In many ways, an extraordinary outcome. One which would not have been expected sort of 10 years previous to that. So the argument that we are making is that the central banks actually were supported in many ways in the achievement of their inflation targetry by the background conditions. And the key background conditions we're talking about are globalization, which we'll deal with first, and secondly, a very beneficial sweet spot in demographic developments in all the major advanced economies. Now, take the diagram on the left. If we go back to about 1980, the left-hand side, the labor supply that businessmen in the advanced economies could take advantage of is represented by the blue line and was about 700 million. But then, through the 80s and the 90s, we had a number of developments. First of all, the Iron Curtain fell, and Eastern Europe came into the world trading arrangement, and also China did. And China, of course, is absolutely huge. And with the arrival of Eastern Europe and of China, and indeed much of the rest of Northern Asia, What you got was a huge increase in the available labor supply, that those businessmen who could shift their production of either goods or, if possible, of services to a low wage area were able to enjoy. So that effectively from, shall we say, the mid-1980s to about 2010, the available labor supply facing a businessman who could shift production to a low wage area effectively more than doubled in size. And looking at the right-hand side, again, you can see how the working age population year by year sort of increased by leaps and bounds. And the turning point is just about 2010, when it all starts turning down and the available growth of the working age population starts decreasing, particularly if you don't take into account Africa and India. And if you don't take into account Africa and India, and you look at the right-hand side, the blue dashed line, you can see that fairly soon there will be zero increase in working age population in the rest of the world, and negative in many of the faster growing areas, including those such as China and Germany, which have led the way in terms of growth and expansion of output in recent decades. So that's globalization. Let me turn next to dependency. We can move on to, there we are. What happened between 1970 and 2010 is that the reduction in the number of young, because of the falling birth rate, outdistanced the increase in the number of retirees. In every major country except for Japan, which aged rather earlier, and we'll talk about that at some length later. Now, that decline in the number of young is actually coming pretty much to a halt, while the number of retirees is now, as a proportion of the population, is now growing fairly rapidly. And that means that the dependency ratio overall, i.e. the number of dependents relative to the number of workers, is going to worsen. And that has a number of in the early stages, when the dependency ratio was improving, this had a number of disinflationary effects. Let me mention but two. First of all, you don't hire workers unless they're going to produce in value more than they get paid. Otherwise, it wouldn't be economic. On the other hand, the dependents, the young and the old, consume, but they don't produce. So that the increase in dependence must be inflationary, and the reduction in the working age population relative to dependence will effectively be the increase in the number of dependents will be inflationary. And if we could turn to the next slide, you'll see that on the left-hand side, the increase in the dependency ratio, the number of dependents per 100 in the advanced economies, the red line, is from now on rising quite steeply. Whereas the dependency ratio in the rest of the world, which had been declining very fast, in other words, was getting better and better and better, is now at least stabilizing and turning up fairly marginally. Looking on the right-hand side, for example, look at China, which is the dashed sort of brown line. You can see that this bottoms out, having fallen very rapidly until about 2010, now goes starting to rise again, so that the ratio of working age population to dependents is going to worsen. And of course, in the Chinese case in particular, to a lesser extent everywhere else, the way in the past that the old were supported during their retirement ages was in the family unit, with the young looking after them. But with the very low birth rate and the one-child policy, there's now going to be very few grandchildren to look after the grandparents. And seeing that coming down the road, the Chinese personal sector savings ratio during the period, sort of 1980, 1990, 2000, was rising, was very high. And it had to be high because they knew that the state wasn't looking after them and the family wasn't looking after them any longer either. So that they really had to save. So you got less investment in the advanced economies, and you got this massive saving boost in China, all of which was disinflationary around the world. Now, the story of China is absolutely crucial, and I'm going to turn over to Manoj to go through that.
Thanks very much, Charles. Before I start, let me say my thanks for having us over here. It really is a pleasure and a privilege. I'll speak about China and its importance. You will see in our book that it is the very first chapter after the introduction. We think it's a story that is given a lot of lip service when it comes to international studies, but the full impact of China in a global story, particularly when it comes to demography, has often remained understated or not formalized. China's role cannot be minimized, and there are three parts I'll walk you through today. First is the very familiar one about China's integration in the global economy, WTO accession, the integration of China's labor force into the world is extremely well known. Along with that, what is also well known is that there were at least two policies within China that really helped massive increases in investment through state-owned enterprises. The first one was the provision of labor, and that almost infinite supply of labor happened through an internal migration. There are many frictions within that which kept labor cheap, one of which is the hukou system of urban passports, which allowed labor to remain very, very open source. And the second one was the impossible trinity was broken by keeping capital flows controlled at the gates of the economy, which allowed domestic monetary policy to run financial repression on households, with the result that household savings went to government-owned banks and then were then redirected to state-owned enterprises to allow them to invest very, very, very heavily in investment. At the same time, places like the Pearl River Delta were opened up to attract foreign investment with heavily subsidized land. Obviously, the labor was there, but also energy and very easy access to business opportunities. So all of that, I think, led to a dramatic transformation, something that we think is a once in history development of any country that we have seen or are likely to see in the future. But today, that story is changing quite a bit in almost every aspect. So today, we think that the main benefits of the internal migration are probably not as inexpensive as they were in the past. In other words, China has passed the Lewis point, and we'll have to start weighing the considerations of further migration into urban areas fairly significantly rising. Second, capital. The influx of companies into China for political reasons and for economic reasons has changed quite a lot. What foreign capital did for China in the past is not just brought a quantum of investment, but also managerial expertise. And because a lot of this was done with joint ventures, a lot of that management technology was passed over to the local Chinese partner. So with the slowdown in the influx of companies and therefore technology, the management of these resources is also becoming harder to come by. And so what that results in is a transformation of not only the external environment, but the economic model at the same time. So one of the things that I think most people are very constructive on is China becoming a consumer-oriented economy. However, with the slowdown in investment, with the lack of a significant amount of capital accumulation, the demand for labor also slows down, and we have seen labor flow from the manufacturing sector into the services sector in the cities, which means that consumption remains a mathematical rebalancing, not really an economic one. The result is China, we don't think, is going to be the disinflationary force that it was in the past. As Charles already mentioned, the falling savings will move the current account much further than it has been from its surplus territory and into the deficit. And the technological change which China had depended on getting relatively costlessly and at a rapid pace will have to be developed at home. We're actually quite positive that China will make a lot of progress in the future. It's just that the low-hanging fruit and the disinflationary impulse that it had in the past is probably behind us. But with that, I'll pass it back to Charles to continue with the argument.
Okay, thank you very much, Manoj. Now, what would you expect if there was suddenly opened up to business a huge pool of pliable, reasonably well-educated labor, which they could take and benefit from? Now, what you might expect would be a huge return to capital management and human skills in the advanced economies, a massive improvement in relative wages in the low-wage economies, and a very, very difficult time for unskilled workers in the previously high-wage advanced economies. And that's exactly what we got. And from a world point of view, what has happened is that inequality has reduced really quite sharply. If we go back centuries and start in 1800, we were all at a subsistence level. And then from 1800 to about 2000, Europe, North America, and Australasia bounded ahead, whereas Asia and most of the rest of the world remained at a subsistence level. Now that is now changing because of the shift of production of goods, to a lesser extent of services, particularly to Asia. If you look at the ratio of the wages of the workers, US to China, and in 2000, the ratio, the US worker earned 35 times as much as the Chinese. Now it's down to 5, and that is a dramatic shift. Been a shift within Europe, from Western Europe to Eastern Europe, not to such a same extent. And of course, there are far more Chinese than there are Americans. So the result is that if you look at the world as a whole, inequality has actually dropped really quite significantly, as Milanovic has actually pointed out. But of course, if you look at the world, as you look at each individual country, inequality has increased because in the advanced economies, the relatively less skilled workers have had a very, very rough time, as you would expect under these circumstances, while the highly skilled and those with access to capital have had a wonderful time. Can we go on to the next slide, please? And of course, the shift from manufacturing to services has weakened labor yet further, because manufacturing, in manufacturing, the labor force was relatively well organized, while in the service sector, frequently described as a gig economy, it's not. With the result, it's both a symptom and a cause of the reduction of labor bargaining power in the advanced economies and the developed economies. The trade union membership in the private sector has steadily declined since the beginning of the 1980s. So on to the next, we could. And this is a picture from a diagram that Autor in the US has developed or set out of the relative growth in the real wages of those with different levels of educational attainment. And as you can see, the higher the educational attainment, both for men and for women, the greater the human skills, the greater the human capital, the more likely they are to be managerial and professional. They've actually done pretty well. But the bottom, the high school dropouts, the ones with only high school graduate, have done really extremely badly, which is exactly what you would expect. In a world of globalization where production has shifted from the high wage to the low wage countries. And that has been the main driving force of inequality during this period. And this has occurred in country after country. This is a diagram from Larry Summers and one of his co-authors showing the shift in the Gini coefficient. If you go up, it's worse. And you will note that it's worse, particularly in Scandinavia and in the United States. But as a generality, inequality has been getting worse within countries at exactly the same time as it has been improving dramatically between countries. So on to the next. One of the particular additional problems which we emphasize is that the worsening of the dependency ratio is made more severe by the fact that the old increasingly need support. And one of the problems here is that term dependency ratio differs in economics than it does in medicine. In medically speaking, the dependence of those who need care. Economically speaking, it just means what age bracket you're in. Now, this is a medical dependency, and this shows that as you age, the number of those needing care to undertake the activities of daily living increases really exponentially. And what we are finding now is that as the life expectancy increases, that we are getting an increasing number and an increasing proportion of those who are sufficiently old, so that the percentage requiring care and medicine, as well as having their pensions, is increasing really quite dramatically. And the need for social security, the need for care, and the need for medical support for the old is going to impose an increasing burden on our public sector expenditures over the coming years. Now, this figure of the baseline projection for the primary balance and the public sector net debt in the UK from the Office of Budget Responsibility was set out in 2018. And you can see how the baseline projections under existing policies, because largely of the rise in the number of the old, is going to get worse and worse at an increasing rate. And this was before the COVID pandemic gave a huge upward boost to it. And it's the same in the US. Next slide, please. And that, as I say, this is before the COVID pandemic. So what we actually see from all this is that these trends, globalization, which is withdrawal from globalization, with political reasons, and the COVID crisis gave another twist to it, because each country insisted on retaining its essential pharmaceutical resources to itself. That the withdrawal from globalization combined with the reversal, the very sharp reversal in the demographic situation, is going to lead the fiscal deficit and the fiscal position and debt sustainability to become considerably worse over time, unless things improve. Now, one of the problems is the reduction in the growth of the working age population, in many cases the decline, notably in Germany and in China, is going to mean that growth is actually going to be lower in future than it has been in the past, because growth is a combination of the increase in the working age population and the productivity of those workers. And the working age population is slowing, if not declining, and a larger proportion of the working age population will have to be looking after the old, which is socially desirable, but economically is not sort of highly beneficial. So growth isn't going to get us out of it. There's no question, I'm afraid, but that in order to deal with the disturbing projections on the fiscal side, the taxes are going to go up. But taxes are politically extremely unpopular. And that means that there's going to be political limits to the extent that taxation, particularly of the wealthy, can be pushed on. And that means that it's likely to be not only the underlying trends of demography and globalization are going to bring about a switch from the position in which labour bargaining power was completely trashed to a world in which labour bargaining power is going to recover. But the debt and political situation is going to mean that for political optimization, the authorities are going to put pressure on central banks to hold nominal interest rates, official short-term rates, as low as they possibly can. Monetary expansion will continue for the foreseeable future and is already very great. So that for all these reasons, inflation, particularly now after the COVID crisis, once that crisis has been overcome with an effective vaccine, is likely to increase and remain higher, much higher than in the past. There will be some increase in productivity because the rise in labour costs will make those wanting to invest more. But it will be very difficult to get productivity per worker up high enough to offset the worse situation in the working age population. All this, I think, was also likely to imply that the yield curve will steepen reasonably sharply once this becomes apparent to all. So that we generally see the reversal of the trends in demography and globalization interacting now with the COVID crisis as leading reasonably quickly, once a vaccine is introduced, to a much higher continuous average rate of inflation. Now, this is not the mainstream, and our views are definitely more, I think, pessimistic than the mainstream, which sees interest rates, nominal and real, remaining rock bottom for a very long time. So I'm going to turn it over to Manoj to set out or to describe some of the reasons why our views about the likely recovery in inflation at a future date have run into such opposition. So Manoj, if I may, over to you.
Thanks again, Charles. So this is towards the closing stage. All I'm going to do over here is talk about some of the things that people find difficult to reconcile as far as our views and theirs are concerned, the pushback that we get, and I'll wrap it up with conclusions. There are 5 things to consider when we talk about the things that we hear about on a regular basis where people find our thesis lacking. 4 of these I've got here, the 5th of which will be Japan, and I'll talk about that shortly. The first one's Africa and India. As Charles showed you on that chart at the very beginning, the numerical advantage that Africa, India, and some countries in South America have is actually not a bad counterweight to a lot of the demographic problems that we see in the West and in North Asia. The problems, however, are twofold. On the one hand, the bulk of growth contributions that the world sees right now are coming from the very places that are going to see a dramatic decline in their demography as far as benefits are concerned. And it is not clear to us, as a second point, that the countries that have benign demographics will be able to convert themselves into something like a China. In fact, we would go so far as to say we probably need multiple Chinas given the backdrop of growth that we have in front of us. However, if you look at the story, I think in Africa and India, the one thing that is clearly lacking is administrative capital. So the ability to transform incoming capital into output and then ship it back to the advanced economies is hampered in the case of India by not only a lot of red tape, but also democratic frictions between the center and the state, which are ongoing right now. And when you look at Africa, it's a population the size of India, but split into 50 countries, which means 50 different sets of policies to coordinate and get over. in order to generate output on an aggressive basis. One could have thought in a different world that you could take some of that population directly and import labor into the advanced economies, but the environment that we're in, politically speaking, it does not allow that to happen either. So what about limiting the benefits to the old? Well, to some extent, this has already happened, and it's been happening for a while. In fact, if you look at the next point, which is the participation of the elderly, and combine it over here, the participation of the elderly has been increasing for the last 20 years. And a lot of that does have to do with the limits of the benefits to the old. So moving from defined benefits to defined contributions, labor reforms. In Germany, you see an extremely clear case where the participation rates among the 55 to 64-year-olds arose in a straight line from 2004 onwards, once the reforms of 2003 were made permanent and put into practice in a very credible fashion. With the result that in many economies, participation of the elderly has gone up and matched the very high level that you see in Japan. The other issue, which Charles also touched upon, is that this is a very difficult disease to deal with and requires a lot of labor. Now, in many economies where official or government medical help and assistance is not available for the elderly, families have to do it. Both Charles and I have had personal experience of our family members, the care of whom we've had to put significant personal time into. And that limits the ability of others to participate for a much longer period of time in the workforce. So there are constraints to how much you can deal with this. But I think one of the most important thing is there is a limit to which you can limit the benefits of the old, because the old vote and they vote aggressively in order to protect their interest. And lastly, the most contentious of that list is technology. We are very supportive of all the job losses that technology can generate by removing the repetitive tasks in our economies, because there will be plenty of jobs looking after the elderly. This is not something that can be transformed. Some of the things can be done by Zoom. We have seen doctors' visits and some other tasks performed online, similar to working from home. But this is at a time when the demographic pressure is not upon us. When that demographic pressure becomes prevalent and significant, we will have to devote many more resources, and we'll need all the job losses we can absorb in the economy. And so finally, it brings us to, well, if this is a compelling argument to some, why hasn't it happened in Japan? Japan has been at the forefront of aging. It's seen as a blueprint almost for the global economy. So why should we not see some of these developments happen at the same time? The simple answer is that Japan had a demographic downturn at the time when the rest of the world was swimming in labor. Or put differently, why would we expect Japan to inflate when at the same time as its labor force started to contract? The emergence of China created a massive disinflationary impulse all over the world, including Japan. But if you look inside Japan very briefly, you see three trends that explain a lot of what happened in Japan, which I think the mainstream has not really taken into account quite aggressively or well enough. The first is productivity. Productivity in Japan has been excellent. So they've been growing at 1% a year. Everyone has seen that. The labor force has been contracting at 1% a year. And the gap between the 2%, is something that most advanced economies would be thrilled to have right now. The second point, far from a picture of a corporate sector that was stressed and put under pressure, Japanese corporates actually took significant advantage of the global expansion of labor, particularly in China and Asia, and invested abroad very heavily. They invested in manufacturing, they invested in services, and that allowed them to retain profitability, even at a time when people interpreted their behavior at home as being a sector that was burdened by debt and by Japan's collapse. And finally, if you look at the labor market saw three things that were interesting, which allowed them to keep wages weak. One, Charles has already pointed out, which is the move almost everywhere in the advanced economies from manufacturing to services, something you can trace back to the opening of China in 1979, which is when the share of manufacturing of the advanced economies in the world starts to fall. The second one is that a lot of the adjustment in China, because of its customs, does not happen through quantity. It happens, quantity of employment, it happens through hours worked and through wages. And the last is the switch to part-time workers. So because the full-time workers were on contracts that were not easy to violate, the move to part-time workers put wages under pressure because these part-time workers had very little bargaining power to negotiate with the corporate sector. And so that brings us to our conclusions. Charles has already outlined them very beautifully. It makes my job much easier. We think inflation is coming, and the coronavirus is going to accelerate its arrival. When we wrote this book, we really did not have a definitive timeline about when it would arrive, but we think within a year from a vaccine allowing us to go back to our life as normal, inflation will significantly outstrip central bank expectations. For the first year or two, both they and markets will welcome it as something they have engineered, another medal of honor for them. But when it lasts and persists and moves higher than they expect, I think the concerns and market pricing will change. The real interest rate point, let me modify. This should have been written as yield curves will steepen, so that the front end, with central banks being politically forced to keep interest rates low, real interest rates could actually remain low for a very long time in the front end of yield curves, but they could rise further on at longer durations. All of which means asset returns will be harder to extract. You have to do your homework. That beautiful bond and equity rally that we've seen over the last 35 years, you'll really have to start working hard for it. The good news is that the combination of all of these things will lead to lower within country inequality, which has been the bane of social strife over the last few years. Along with that, productivity will also help raise real wages as companies look to try and use labor-saving technologies. There will be some problems. The debt trap has to be dealt with. How you introduce taxes, either through corporations or land taxes or carbon taxes, will have to be dealt with. But one of the biggest changes that is coming is that this really cozy relationship between central bankers and finance ministers, which has been perfectly symbiotic over the last 30 years, is probably now coming to an end, because central bankers will find it very difficult to allow economies to grow and support fiscal expansion on the one hand and control inflation on the other. We believe that it's the fiscal policymakers and the administrations that will win out in most places, and that puts central banks in a very, very, very different position than they've been over the last few decades. That's it from me. Back to you.
Thank you very much, Manoj and Charles. That was a very comprehensive analysis, and also very sobering, even at the end. What I found particularly interesting is that much of that could have been foreseen in terms of using very standard economic models, as you showed. If you look at the opening of labor markets worldwide, there's a very old-fashioned theory, Heckscher, Olin, Samuelson, Stolper, which would exactly predict what you show in the data. And also in terms of responses, the very old growth accounting literature would somehow come to very similar conclusions as you've derived them. So I found that very useful, very highly impressive. What I forgot to mention right at the beginning of our session, that I would like to invite participants to come up with questions. We will collect them and we will address them at our two panelists. Maybe I start with a first question, if I may. So let's go for growth accounting, and let us force to be positive. Couldn't be, in addition to the mitigating factors which you mentioned, technology be incredibly helpful in terms of dealing with the issue? So that's what all those who are really optimistic with regard to the use of IT and so forth would suggest. So couldn't be a productivity boost coming from the application of all these new technologies which are now around, at least to a degree mitigate what you tell us?
You remember what Bob Solo used to say, which is, there's all this wonderful new technology with computers and the rest of it, and I see it everywhere except in the GDP figures. And we've had technological improvements, and you have to assume that technology innovations will increase even faster in future than they have in the past. And we're not experts in the field of what is likely to happen in technology. But do remember that there's Bob Gordon's argument that actually we've picked all the low-hanging fruit, and the technological improvements may actually start to decline rather than
You shouldn't have mentioned that.
That's right.
Yeah.
So yes, and we can always be rescued by various miracles. We could find that medicine suddenly discovers a way to deal with the major infirmities of the elderly, and we could find that they discover how to cope with Parkinson's and dementia, but they haven't in the past, and to hope for that, I think it would be foolhardy, I think, to believe that a miracle, either technological or medical, is going to get us out of many of these problems. And we have to prepare for the future on the basis of practical probabilities.
So I'd add just one small thing. In a sense, the lowest hanging fruit have already been deployed in many cases. The large move that you saw into China is, if you think about it, some way of technology, labor, and a cheap source of capital working in a supercharged fashion to move investment out of the advanced economies and into China to create a very much more even global platform. And so from here onwards, I think the lowest hanging fruit that you would get, not only for involving technology, but using the global economy to get us out of the spot that we're in, it will be that much harder to come by. Of course, like Charles says, we could get changes in technology happening very, very, very rapidly. But for a lot of the things that we think labor will be used, which is looking after the elderly or for education, a lot of these have been threatening to come along for decades, in fact. And it hasn't happened. If that happens, of course, we will be the first to say that things have changed dramatically from our view, but we don't think that is anywhere close, in our opinion.
Guys, you're stirring the pot quite a bit. I'm collecting questions. So the first one I have is from Timo Klein. Timo asks, what about retirement age? Can't we assume that retirement age will go up towards 70, 75 if people are so healthy and work is possibly not as stressful?
Well, first of all, they're not that healthy. Remember the figures that I put up about dependency ratios. In the age group 75 to 85, 50% of everybody will need some form of care assistance. And a lot of that care assistance will be provided by their partners if they're still there. And in any case, the physical jobs, it's difficult to see how you can raise that, because it is very hard to undertake heavy physical activities once you get much beyond about 65. Yes, I think that the retirement age will rise, but for the last 30 years, life expectancy has been rising faster than the retirement age. So the gap between the two has been increasing. And it is undoubtedly possible with COVID and other problems that life expectancy will cease going up. And I think the retirement age will rise somewhat. But given the health and other and physical problems of the aged, I think the idea that we all are going to work until we're 70, I think that the if you like, the professional classes, those who work mostly with their head, the cognitive skills, will probably go on working to their 70s. But I think that the majority of the population, it will be very difficult and be very politically unpopular. The vote, the old vote, they've got a very large voting bloc. And you can imagine what will happen if suggestion is to raise retirement ages. What's happened in most advanced economies is because of the unpopularity, retirement ages are raised usually about 20 to 30 years in advance, and then very gingerly. And Putin, who was one of the strongest political controllers of his country that you could think of, the one thing that he found extraordinarily difficult to do was to raise the retirement age. So on political grounds, I think it will happen very, very slowly, if at all.
Charles, you seem to be confirmed by French experience, 1985, and also more recently. I do have a question from Harald Stieber, European Commission. He wants you to talk about Japan. Why is Japan crawling out of that debt trap? Why is it protected against inflation?
Okay, I can give that a crack, Charles. If you want to add anything, I think please feel free to. We don't think it's protected from here on, but over the last 3 decades, Japan. I'm going to reiterate some of the things we talked about, but we can go into more details. Over the last 3 decades, Japan really has been seen as a story of autarky. So I don't know how popular this is throughout, but if you look at the popular narratives among Japan, some of the popular narratives are that of balance sheet recessions and the lost decade, so on and so forth. That analysis, from everything that I have seen, and please do tell me if you've seen very different ones, from everything that we have seen, it takes Japan as an economy in autarky. It looks at Japanese demographics, it looks like Japanese growth, it looks like Japanese investment within Japan, Japanese wages, and then tries to fit everything within that closed economy model, except that Japan wasn't a closed economy. There was no way for Japan to actually stop the disinflationary forces from China or from this global surge of labor supply at its doors. And Japanese corporates were very quick to react to that. So they cut down operations within Japan, which kept investment very low. They tried to disengage from these lifetime norms of employment by shifting into part-time work or cutting hours, and at the same time heavily invested abroad, but did not repatriate profits, which meant that the reinvestment rate over there was very high. So if you look at the ratio of international to domestic manufacturing production, or as far as investment is concerned, or labor employment, Japanese corporate footprints in the rest of the world, particularly in China and North Asia, actually grew remarkably at a time when they thought they were going through a lost decade. This is not really a picture that looks like a terrible economy to be in if you just open up to the rest of the world being an integral part of Japan.
Could I add a couple of other points?
Sure.
First one is that interest rates tend to equate around the world when you don't have exchange controls. And this has been a period of exceptionally low real and nominal interest rates. So the debt service ratio on Japan's huge public sector debt has not been a problem for them, at any rate up till this moment. Another point that I would make is that Japan is a huge net creditor, and therefore there's been no worry about sort of not being able to pay its debt to foreigners, because it has a huge net surplus and vast holdings of US of debt, of government bonds. So for both these reasons, the debt service ratio remaining exceptionally low and it being a huge net creditor means that Japan's overall position and sustainability has not been under any significant threat whatsoever.
My friend Oliver Landmann is going in the same direction. He would like to ask you, is debt sustainability an issue if real rates are very low and actually if rates are below the growth rate of the economy?
Well, the real growth rate of the economy, in our view, is going to probably decline because of the decline in the working age population, unless there's a very considerable productivity improvement. We expect some, for the reasons that Manoj so clearly set out, but we think that overall growth over the next few decades will be significantly slower than it has been over previous decades because of the demographic factors. So we're not going to get growth higher through real growth. Where we think that we could get a improvement for debt sustainability is when nominal growth is higher than nominal interest rates, so that what we're going to have is a much lower or continually very low real interest rates at the short end, because inflation will be a great deal higher than the official short-term interest rate. So and our view is that we're going to inflate the debt away.
So the question might be more troublesome if you didn't have inflation in the picture. If real rates could remain lower than GDP growth rate, then, as Charles was saying in the case of Japan, debt servicing doesn't really become that much of a problem. I think the issue that we also have to consider is what happens to inflation, and what central banks are torn to do. Are they always going to remain with interest rates very low? Will the market take them up on that? What happens to the risk premia that markets enforce? What happens when refinancing rates go up? Right now, 5-year, 10-year, 20-year yields are extremely low, and that makes things very easy. But if there is no central bank action and inflation persists for a very long period of time, and those rates go up, even if the front end remains anchored because of central banks, what happens to refinancing costs over there? That, I think, is something that also makes the picture a little bit murkier.
I think Oliver was referring to the argument which has been defended also by, in particular, Olivier Blanchard at his AEA conference contribution last year. So with the wedge between growth rates, nominal growth rates, and nominal interest rates, you might have the possibility to buy some time. That's basically the argument. I have two questions here concerning central banks. Heinrich Siegmann asking, central banks are holding a huge amount of government debt. Shouldn't one expect that they might somehow forget about them? So forget about Article 123 of the Treaty on the Functioning of the European Union, monetizing debt. And there's another question somehow along the same lines. Thomas Mayer, if central banks do not raise interest rates in response to rising inflation, what's going to happen to inflation expectations?
They will rise, but slowly. And remember, it took a really quite.
Just give me a second, because Thomas was alluding to another option. He's thinking about what about debt restructuring?
In what sense do extend and pretend, and
haircuts,
some form of default, and inflation itself is a form of default, of course. Yep. And yet there may be debt restructuring. It's difficult to see quite how else, if these inflationary forces do take hold, quite else we're going to deal with the situation. Because unless we get the growth, and we've argued that growth is likely to disappoint, what else are we going to do?
I have two questions concerning what about climate change?
We haven't dealt with that, and you can't deal with everything. Our book does not address climate change at all. One thing that I would add is that the demographic difficulties that we see coming up are going to hit in particular the countries which have been at the forefront of growth, and that includes Germany, it includes China. But another group of countries which have had huge current account surpluses, of course, have been the oil-producing countries. So one of the implications of our work is that the previous very persistent current account surplus countries are virtually all of them, oil-producing countries, Germany and China, are going to find that the current account surpluses are going to disappear. So quite what the pattern over the future coming decades of the international trade and the pattern of current account surpluses and deficits are going to be, we don't know. It's very hard to predict. All we are predicting is it won't be anything like the current pattern. And our view, basically our view is, as I think you said at the outset, the future is going to be very, very different from the past. And most economists, most commentators, and the mainstream view is that the future will just be a continuation of the past. And our warning is that that is not going to happen.
Yeah. Extrapolating didn't work too long. Nowhere. There's a question on China and the vanishing current account surplus of China. What does this tell us for capital flows, international capital market integration? What does that spell for the US consumer of last resort for basically the whole period you were carefully looking at?
Manoj, I'll pass this one to you.
Sure. I mean, some of the decline in, I mean, there are clearly many different ways to cut the current account balance, right? But one of the ones that we have put at the forefront is the usage of the savings when it comes to demographics in China. And so from that point of view, I think the move towards the consumption is being looked upon as a very favorable development, as passing the baton on to the Chinese consumer, who will then become the driver of growth, and address all the concerns about where demand will come from over a longer period of time. It's a very difficult proposition to defend, except in a mathematical sense, because as Charles showed you, one of the things that has happened for inter-country inequality is that the ratio of US wages to Chinese wages has fallen dramatically. But part of the reason for that was an almost military-like expansion of capital, a huge demand for labor, and a massive initial increase in wages from a very low starting point, from the move from rural workers to urban workers. A lot of that is very, very, very hard to sustain. So thinking that China rebalances out of state-owned enterprise capital accumulation into more technology, which we've seen in the advanced economies, is not labor intensive. The labor force moves into the services sector, working for the gig economy in urban China, which is one of the problems they have in restoring employment right now. That's why fiscal policy has to be so aggressive, because monetary policy is not geared towards SMEs. It's just very difficult to defend. If real incomes are not going to grow because the Chinese economy is not accumulating capital as aggressively, then the Chinese rate of consumption is going to be a larger share of the economy, but not growing at a dramatic pace. So it's not a 5% consumption growth story. It can't be. It will be in a much more normal realm of somewhere around 2.5%, 3%. And so the Chinese rescuing the world once again, as they did it after the great financial crisis on a structural basis this time, I think looks like a very, very, very difficult proposition. The second part of that is that they're no longer a disinflationary force. at the margin, they're probably likely to be a slightly more inflationary force than they've been for the last 30 years.
What I find really remarkable, you should be aware of where you're talking here, Manoj. You're talking in a Bundesbank environment. And you know where inflation comes from, don't you? You're continuously referring to arguments which are not that well versed in our continental European environment. But I have a question with regard to that. Christina Molnar, Norwegian School of Economics. Are you worried about the expansion of central bank balance sheets? So that's monetarism, see? Central bank balance sheets, base money. Together with inflation and aging, won't it make monetary policy less effective, less efficient?
As the new governor of the Bank of England, Andrew Bailey, said, that if they do have to reverse gear, they will try and reduce the balance sheet by running down, reversing QE before they start raising interest rates. But I doubt even very much whether they really will be able to do that without running into political opposition, because the pushing more public sector debt onto markets at the same time as the deficits remain very high, unless you get huge increases in taxation, will generate longer term interest rates up. That's one of the reasons why we think that the yield curve is going to steepen and steepen quite dramatically. My rather skeptical view is that actually, although they're professing not to do so, the central banks have actually been undertaking modern monetary theory, although they claim not to be, in the sense that the balance sheet expansion that they've undertaken is not going to be reversed for a very, very, very long time.
Charles, you wanted to be slightly more polite. You wanted to say they are undertaking functional finance Eberpy learner style. But one of the ways out of this, as you said, is if fiscal policy is quite derailed. One of the ways would, of course, be using inflation, the social modifier.
Yes, that's exactly our point.
Yeah, you mentioned it. So there's another non-monetarist explanation for inflation from...
Well, and they go together in the sense that the politicians, because of the importance of inflation as a social modifier, the politicians will put great pressure on central banks not to raise interest rates, nor to reduce the size of their balance sheets, at any rate not aggressively. So yes, it will be monetary as well. Inflation doesn't happen unless monetary policy is consistent with that occurring. And in that sense, inflation is always a monetary phenomenon. But we see the politicians putting great pressure on central bankers to modify their actions and to not to either cut back their balance sheets nor to raise interest rates. Now, in most countries, the politicians actually have the last word, and particularly because they can appoint whoever they want to the policy committees. But the great exception to that is the ECB. And the situation in Europe, I think, is going to, in the EU, is going to be much more nuanced. Is going to be, and the politicians have much less grip, much less control over central banks in the case of the ECB than they do in the case of the Bank of England, the Fed, or the Bank of Japan.
That's where I actually would like to raise a question of my own. Doesn't this mean, or does this really mean that the ECB is stronger? Couldn't it be the case? I'm just thinking of your beautiful article on game theory for central bankers. 20 years old or so. couldn't it mean that this institution, which seems to be most powerful, is forced to come in, so that you have a fiscal and financial dominance, because you have all those weaklings, 19 finance ministers who can always kick the can down the road and tell the central bank to pick up the pieces? So couldn't it
But they can't tell the central bank. They have less control.
but they don't do anything. So they just let things fall apart, and ultimately whatever it takes.
Well, possibly. Again, the thing, we're very much in the realm of politics, and I think that one has to be in the realm of politics. And the question I think that you're raising is, couldn't the ministers of finance in your 19 countries insist on appointing central bank governors who are prepared to be so dovish that they will allow and encourage sort of monetary expansion that will enable inflation to take hold? And you may be right. I don't know the answer to that one. It's a political issue that you have to consider, or needs consideration. But this isn't going to occur, you know, that there's quite a lot of time before this will happen. And I think it will, and quite what the political situation will be within the EU under those circumstances is a subject which you're probably better versed in than I am.
Thomas Meyer is coming back with a complicated question. I'll just read it. Should we perhaps see inflation as a means to redistribute real income from the dependents to the working age population? Real assets are reduced and real benefits are cut when nominal benefits are not raised.
To some extent, yes. I think that is again true, because the pensioners are going to have a horrible time. Indeed, one of the immediate short-run problems is going to be what will happen to pension funds if and when interest rates start rising. And they were already under great pressure as it is, and life could become a great deal worse for them if their assets start falling in value. No, and I think that that's a very fair and excellent point, which I accept.
To add one bit to that, I think also the labor bargaining power increases under our scenario. And so labor is able to negotiate higher after-tax wages, which will be, the taxation story will be required to finance aging-related expenses. So yes, I think that's a very valid point he's making.
Mm-hmm. I have two central bank related questions. Harald Stieger comes in and holds energy prices, marginal cost of energy going to zero. There won't be any oil price shocks anymore. No supply side shocks. Isn't that easing the task of monetary policy?
It might do, but I think the idea that price of energy is going to go down to zero is more than a little bit hopeful. Yes, the wind is free and the sun is free, but where the technological developments are really necessary is in transmission and in storage, in batteries. And we're a long way from getting the development in battery technology and in storage. In principle, we ought to be able to soak up the sunlight in the Sahara and transmit the sunlight from the Sahara to Northern Europe. But we're a hell of a long way from doing that. I take, for example, Iceland. Iceland is swimming in energy. The problem is, how on earth can it use it? And there have been all the studies about trying to get the Icelandic energy from hydro and all the rest of it over to the UK. But transmitting energy is actually extremely complicated, pretty expensive, and we're a very, very long way from solving the transmission and the storage problems.
Same with shale gas, by the way. It's a similar story.
So one of your chapters is about debt and equity.
Yeah.
I think it's chapter 9, if I recall it.
No, 11 and 12.
Come on. I didn't want to read the electronic version, which was forced to. But this goes to a question which Alex raises. I unfortunately don't know his last name. He says, what about financial repression? If the if central banks do yield curve control, as the Fed did until 1951, and as the Bank of England was also somehow supposed to do, Charles, correct me, until 1997 or so, somehow.
We gave up in 1981, really, with the under Maggie Thatcher.
I thought you became independent in 1997.
We did, but the financial repression sort of ended. It ended with exchange control.
Yeah.
And yes, there will be a great tendency or an incentive for central banks to reintroduce financial repression. But the question then, I think, is, can you introduce exchange control? If you can't introduce exchange control, then you really can't undertake repression significantly, because people will just reinvest abroad, and you will have difficulties on the balance of payments front. So I think the question is, yes, the incentive to do that will be there and will be very considerable, but will countries or monetary areas be prepared to introduce exchange controls between themselves and the rest of the world? And that again is a political question that I think is, and at the moment the answer is that it would be unthinkable. But what's unthinkable now may become thinkable in 5 years' time.
Even if you think about a coordinated set of yield curve control measures, I think the problems just pop up somewhere else. So that becomes a very pro-cyclical story as far as inflation is concerned. If inflation goes on rising and remains persistent, I think if you look at market measures, break-even inflation will be above nominal yields at all maturities by a considerable amount. Initially, that will be good because that will move tips or real yields lower, and everyone will love that. But eventually, it starts to take a toll on capital allocation, on equity valuations, on exchange rates, and just in general, a great uncertainty about when it is that central banks are going to raise rates. I think initially it will be no problem at all. It will be seen as a success. But it will lead to distortions. Just because you tamp down on nominal yields doesn't mean you've taken care of inflation. If you didn't have inflation, then none of this would be a problem. But that's precisely our thesis.
Manoj, there's a question exactly addressed to you. Fabian Bichelmeier. Corona vaccine arrives. Why does it accelerate inflation?
Well, the argument that we are making for inflation is twofold. There's a structural element to it, which we were not really sure about the timing of which we have taken a considerable amount of time arguing. The issue that we have with the coronavirus right now is that the environment that we are in at the moment is clearly disinflationary. As Cavallo and a lot of other people have shown, that the COVID basket and the CPI basket are considerably different at this point in time, with the effect that really the inflation prints that are coming out right now are fairly meaningless. There is an underlying deflation that is happening. And so as that spending flow is moving to a lower equilibrium until a vaccine shows up and life remains abnormal, we're seeing two things happening. We're seeing, as the ECB has shown in recent research, the surplus on the household side is really forced savings. It's not precautionary. That's not the case. In fact, if you think in a very strange sense, the level of unemployment during the coronavirus pandemic at the depth had never been lower, because everyone was employed by the government. They were being paid a full wage, in some cases more than a full wage. And so what happens over a period of time is you get that pent up savings that is not being deployed because habits haven't really changed to completely change our lives. At the same time, the capital stock in the economy and the level of employment in the economy start moving lower. When you do get a vaccine, a lot of that forced savings comes out into the open at a time when you've had bankruptcies, you've had permanent job losses, so the supply side has become far more restricted. But now you've got these absolutely gigantic monetary and fiscal impulses, which will remain in place until we are sure we've reached escape velocity. The difference between the two, we think, will be a real reason that a nominal variable like inflation rises.
Escape velocity is very positive, isn't it?
Yes, it is.
I have a more sober question. Paul Burrick, actually 3 questions. Will standards of living decline if inequality is reduced? So is there a disincentive to create wealth if inequality goes down? Secondly, is there a difference in terms of the perspectives for workers and dependents? And third, do we measure standards of living appropriately?
Sorry.
I was watching a Yes Minister episode just very recently, and they were talking about a question being passed around, and Jim Hacker says, well, can you blame them when you can hear it ticking? So this is it's a nice question for Charles to pass on to me. It's very clear by the question itself that we are clearly not measuring the standards of living appropriately. A lot of how we quantify access to resources, whether those resources are being measured correctly with all the spillovers, the ESG arguments that have currently and rightfully become so popular, I think are very difficult. But I think the decline in inequality should not really lead to a dramatic desire to not accumulate wealth any further. In fact, I would argue to the contrary, that people would have to work much harder to generate that level of wealth. That doesn't mean they just give up. I think that would mean that they look for ways that will protect their wealth. No one just runs away from a threat to wealth by doing nothing. And that's one of the reasons that we think that the corporate sector, for example, just to give you one example, will actually start investing in capital in order to raise productivity and to try and keep that wedge between its revenues and a rising cost of labor. If they don't do that, they will go further and further down, and that would lead to market share being lost. That's not the way the corporate sector has generally behaved. Profit maximizing or wealth maximizing behavior, it's not something that will not react to adverse conditions. Now, whether they will be successful, I think, is a different matter, and how successful they will be is a different matter, because it's clearly not easy to raise productivity. Otherwise, we would have been doing that all along. But I don't think that changes the incentives to try and create wealth. I do think there's a tug of war that's coming. I'm not sure we'll win it, but I think we'll go quite a long way to fight against it.
Charles, would you like to add to that?
No, I thought that was splendid. I was hardly listening.
Passing the can again.
I was hardly listening to the question, but I was trying to unmute myself with difficulty. So
you're not allowed to unmute yourself. So I think we are coming to an end of a very instructive and provocative session. I would actually like to invite the two of you sometime around next year around the same time, in person, Charles. Because I would have about 30 other questions, which I have lying in front of me here. And they would relate to arguments which were defended around secular stagnation. And because you mentioned Bob Gordon,
yep,
about his 7 headwinds, and you basically referred to 3 of them. So this is a long-lasting tendance lourde issue, very important also for policymakers. And I would, in particular, we would like to ask you, what should policymakers do going from here? What should they do during a transition period? And to give you a little bit of advance time to prepare, I guess we should invite you sometime next September 2021. Hoping that the vaccine is out and hoping that you're right, that inflation is coming up close to 2, but below 2.
I think that once the vaccine is there and the economy comes back, that there will be a bounce back in inflation. Incidentally, the inflation figures we got at the moment are largely meaningless because they're based on a consumer basket which doesn't bear any relationship to the consumer basket that people are actually using. So there's massive downwards pressure on the stated figures. So don't believe the current CPI figures. The difficulty is that as long as we can hope that a vaccine will be coming, we do need to try and attenuate the companies which will be viable when we get back to something near normal in the interim period. So I don't think that there really was any serious alternative to what central banks were doing over recent years. And they and the fiscal policy will have to remain expansionary during the period before we get back to normal. And then once we get back to normal, the immediate response of all the central banks to a rise of inflation, anything up to about 5%, will be, this is splendid because this simply offsets the previous undershoot, is what happens afterwards. So the problem that the central banks will face will not come for 2, maybe 3 years, but it will come. And I think the point that we're trying to make is that the world may be a lot more difficult looking forward 3, 4, 5 and further years ahead than they currently realize. And they'd better be prepared for what might be coming down the road at them. And just to believe that interest rates are going to be rock bottom forever in the future, so we don't need to worry about debt, for example. I think that's Pollyanna country. I think that they just need to be concerned the future may be a lot more difficult for them than they think at the moment.
Thank you so much, Charles. Thank you so much, Manoj. That was an excellent session, excellent seminar, and hope you're not too right what concerns your gloomy perspectives.
We hope so too, but we need to be realistic.
See you soon, guys.
And at any rate, we'll be happy to take you up on your invitation. Thank you very much.
Thanks to the audience, of course, for participating so constructively. Thank you so much, and hope to see you soon on this channel at the Safe Policy Center lectures, where we try to inform public debate. So we are Aufklärer, as we used to say, enlighteners. And that was a great one. Thank you so much, and bye-bye.
Thank you too. Very kind.